This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. It is Wednesday, January 3rd, 2024. We are done with the second trading day of the new year, but it is the first show of the year to feature our friend Luke Guerrero. Thanks for being back with us, Luke.
Thanks for having me in 2024.
Yeah, exciting times. And as usual, we are here to help you, our listeners, take that next step in your financial journey. And we do that by answering your finance and investment questions and bringing you topics and data that we think are important for you to consider when making your investment decisions. And the overarching goal will be to give you the tools, not just one piece of data, not just perspective on one company or one sector, but really the tools for you to make good decisions with your money consistently throughout your life. And we're going to do that one step at a time, one show at a time, 1 hour at a time. So we're going to run down some show topics as well as the market performance for today, but right after we answer our first caller question now.
Hey, Steve and Justin, thanks for taking my call. I'm wanting to hear what you all have to say about ZIM, Z-I-M, Integrated Shipping Services. Just wanted to hear your opinion on the stock.
All right, this is Zimmer Holders, ZIM Integrated Shipping Services, ZIM is the symbol. I remember getting calls on this in May of last year. And it just peaked and it was rallying from a low of 51 after it recently peaked around 86. And it was moving up towards 70. And it looked cheap based on 2022 earnings of $38 per share. You're talking about a multiple of 2. The problem was that it was pretty clear that the forward-looking projections for earnings were pretty bad. And you saw last quarter, Luke, they lost $18.90 per share. So this is one of those classic examples of just looking at the latest earnings numbers and a standard P ratio didn't tell the whole story. And clearly you have to look back in the history of this name, and it never really had good profitability. Now, it is rallying now, but to me, I don't see any strong fundamentals behind this. It looks more like a short covering rally to me. What are your thoughts?
Yeah, that could be the case. I mean, there's 24.22% short interest, but I just don't like these companies that are making no money. Their debt is 4 times what their market cap is right now. Looks to me like it's cheap, but it could be a lot cheaper pretty soon.
Yeah, I see this as, from a technical perspective, it looks fine. It just started to rally, broke above the 100-day moving average just about a week or so ago. It's consolidating, and it's on pretty good volume. But to me, this is just a flash in the pan. If you want to play it as a trade, fine. But you're going to have a tight out. You have to have a high risk tolerance level. But the history of this business says 2021 and 2022 were simply anomalies. And historically, they don't make much money, and now they're losing a ton of money. The last 3 quarters, each and every quarter, they've lost money. So only as a trade, maybe, but not as an investment. Now, we have a lot of ground to cover. We have 40 minutes with you, and we have a lot to talk about. And our main focus point is set up by this headline. There are 4 new rules for investors in 2024. And these strategists lay out their takeaways. I personally agree with some of them, and others not so much. So we're going to look at what they're saying, see what makes sense, and we're going to go over the 2024 economic outlook, whether the recent bond market rally can continue, and whether taking on interest rate risk right now makes sense. So we're also going to touch on the Fed minutes. They came out today, and is looking back at what the Fed was thinking during the latest Fed meeting in, what was that, mid-December? And obviously that's going to move markets. There's also a big trend in companies issuing convertible debt. And that's a lot of companies that typically don't issue convertible debt are now doing that because of higher rates. So we're going to talk about why that is. And then lastly, if we have time, we're going to touch on auto sales. Good year in 2023. Will they repeat that in 2024? So that's what's on the docket for us, as well as some voice bank questions. One is about Roth IRAs and VEGI, the iShares MSCI Agriculture ETF. So that's what we're looking at on today's show. But let's take a look at the market today. Luke, we had a big sell-off yesterday led by semiconductors and a lot of the Mag 7 stocks that led the market last year. And today we had another negative day overall, more intense on the small cap side, but you had some big movers down. Tesla down 4%, SoFi Technologies down 13%. You had Palantir down 3%. So certainly some big losers as we go through our second trading day of the year. What did you see?
Yeah, I mean, overall, I think the theme of stretch positioning and overbought conditions that's been the case over the past several weeks kind of played out here. You had a rally going into the end of the year, a lot of people probably at a gain or maybe a break even, not wanting to sell for tax purposes, and you're seeing a general shifting and rotation out of those names that led that rally. I think a lot of people are saying that 2024, if it is a positive year, is going to be a year of broadening of the rally that we saw in 2023, but that really starts with this rotation that we're seeing out of the names that were the big winners. There were some big economic reports today, the JOLTS job summary, ISM manufacturing. I know the JOLTS job report came in slightly lower than expectations, but there really hasn't been anything to shift the narrative. And certainly the Fed meeting minutes are confirming that we will see some cuts this year, albeit we don't exactly know when. So not many changes in the narrative, just a general shifting of positioning.
Yeah, that overbought nature that happened pretty quick. And when I say pretty quick, it's, when the Fed pivoted, the Fed paused, shall we say, and the market rallied in a pretty strong manner from late October, pretty much into the beginning of December. And then I think the market kind of levitated in December because of Santa Claus rally, as well as, like you said, a lot of people not wanting to take those gains into year end. Now there's a relief. I can take those gains. I don't have to pay my taxes until, sometime in 2025. And that precipitated that sell-off. So we'll see how far that goes. They usually say how January goes, that's how the rest of the year goes. But we're only 2 days in, so we'll see as we get into the back half of January, past the option X. That will be important as well because of how important options are in market flows these days. And so a very interesting start to the year, and you continue to see the growth side of the market struggle. Now, as we go to break, let me remind you to check out our new InvestTalk Classroom series. Our latest episode is up on our YouTube channel. It is free, and it's titled How to Prioritize Your Savings. We talk about the 40-30-20-10 rule, as well as how to focus on keeping your habits in check for the new year. Luke and I break down these topics and more in a short 6-minute video. Just search the InvestTalk Classroom over on YouTube. Now, the phone lines are open, waiting for your questions at 888-99-CHART.
Every investor is working to build a secure financial future.
Would this be an opportune time to get into annuities?
Everyone's situation is different.
Get your thoughts on CRM, Salesforce.
And so are their questions.
And I was just calling for your assessment of Blackstone Incorporated.
To get your take on QE.
Ticker symbol LECO.
Just wanted to get your opinion on JP Morgan.
InvestTalk hosts Justin Klein.
I'm okay paying a fair price for a very good business.
Steve Peasley.
It's a very well-run company.
And now Luke Guerrero.
EBITDA growth is significantly higher than its competitors.
Are ready to provide their unbiased answers. Each podcast is unique, and you set the agenda.
I will.
Hey, hi, Steve.
24/7, rain or shine, InvestTalk is made better by the power of you. Call 888-99-CHART. Here's a reminder about the KPP Premium Newsletter distributed to each subscriber's inbox every Friday. The newsletter provides a roundup summary of the week that was, offers a look ahead, and even puts forth some interesting stock ideas. And you can subscribe to the KPP Premium Newsletter anytime at investtalk.com. Have you got a question for Justin? He's here, and the lines are open. 888-99-CHART.
Let's go talk to Jordan. He is just south of me in San Clemente, California, looking at Sprouts Farmers Market. Do you own it, Jordan, or looking to buy it?
Yeah, I own it. I'm just wondering if it's a buy or a hold.
Well, this is one of the holdings within our portfolios for clients that we've held for an extended period of time. It's now trading at $47.86. We started buying it right around 2020 timeframe, and it right around in the high teens, low 20s. And so it's been a big winner for us. So we really like it. And one of the big reasons why we liked this is because of the secular dynamics within the grocery market. And for everyone out there, this is here in Southern California, I wouldn't say they're huge, but they are our presence, and they're certainly growing. And they operate 386 stores in 23 states, like I said, mainly in the western part of the United States. About a $4.8 billion market cap. So we were investing it back when it was, $1 or $2 billion. Minimal debt, no dividend, but they use their cash flow to kind of grow that store count. Revenue growth last quarter up 8% year over year. And what we see is more and more people are focused on their health, buying organic groceries, and that's what Sprouts kind of specializes in, kind of fresh, organic, natural groceries. And so I saw that. Also, people are working from home, so they tend to eat out less. The cost to eat out is certainly a lot higher. That spread between eating out and eating at home is a lot higher than it used to be as well. So that benefits, all those factors benefit Sprouts. So obviously we like the company. Good profitability, good balance sheet, good growth, etc. Now, near term, it's a bit overbought. Today, you had a bit of a pullback, so I wouldn't be in a huge rush to be buying. We're not buying it, rushing to get in for new clients to come aboard with us. But a pullback back to the 100-day moving average in the low 40s. Right now, it's about 47.86 at the close today. That would be good support that I would say you should pick it up. So we like the name. I like what you're looking at, but a bit overbought and probably needs a bit of a pullback for you to get a good buying opportunity. Make sense, Jordan?
Would you take profits?
Would I take profits? If you want to rebalance a little bit, maybe, but it's not overvalued, so I wouldn't be too aggressive.
Great, thank you.
Thanks for the call. Now let's squeeze in one more InvestTalk caller question here before the break at 888-99-CHART.
Hey, can I have your opinion on buying this ETF for a long-term investment? Ticker symbol is VEGI. Thank you so much.
All right, VEGI is the iShares MSCI Agriculture Producers ETF. Luke, a 39 basis point expense ratio. Let's see what the portfolio consists of. Let's see how many names there are. Mine's taking a second to pull up. What are you seeing on your end?
Well, I'm seeing it's around 60% large caps, 27% mid caps, and then about 8% small caps. There's 148 total holdings, and the top 10% represents about 60% of that. Overall, given that it's probably tilting a little bit more towards small caps and mid caps that I'd expect, that's probably why there's a little bit more of an expense ratio. iShares products tend to have low expense ratios. Another interesting part of it to me is that their revenue exposure is only 38% U.S., so in terms of where their revenue is coming from of these companies, it's pretty well diversified across regions.
Mm-hmm. And yeah, based on what you just said, the biggest, I wouldn't say red flag, or the most interesting note you had there was the concentration. The top 10 holdings are 60% of the portfolio, and the top holding is Deere, 22% of the portfolio. That's a lot. You have to really like Deere to make it basically a quarter of this fund. And if you look at its sector breakdown, it's basically a third between basic materials, industrials, and consumer defensive. And so you also have to like those. I like 2 out of those 3. I'll say that, the industrials and the basic materials. So it's okay. You know, some of the names I like, some of the names I don't. You know, my biggest worry, though, is just looking at a chart. This is in a downtrend. So while I like some of the names here, obviously the trend within the ag space is down. And until that improves, I wouldn't be excited to jump into this name. So I would be picking ones within this that have better trends than the overall ETF. Now we're heading into a break, but we're happy to play your recorded voice bank questions, but we love taking your live calls most of all. And our number never changes, and it never closes. It's InvestTalk at 888-99-CHART.
This is InvestTalk, and we're glad you're with us today for 1 hour of financial news and perspective. And your decision-making process can benefit from this practical and unbiased advice, especially if you consult with Steve or Justin. Step up now with your questions. Call 888-99-CHART.
Let's go to James in New York looking at FNV, Franco-Nevada.
Yes, I've been sort of dollar cost averaging into that position, and I was wondering if it might still be at practical levels for me to do so if I wanted exposure in the space.
Well, do you understand what's going on with Franco-Nevada right now?
I have, yes.
Okay, so you're familiar with kind of the controversy down in Central America, in Panama, and you know that could go either way. Usually these things are resolved, and these sell-offs tend to be good buying opportunities because, you know, in that part of the world, let's just say grease enough palms and things happen the way that these companies tend to want them to go. And ultimately, I think they get back on track, and I do think this is a good buying opportunity. And the technicals have started to reverse. You had a reversal back on the 13th of December, and it's been consolidating ever since. So if you're looking for entry into one of the best, I don't want to say a miner. This is actually a gold and precious metal streamer, which is different than a miner. They basically invest in various mines throughout the world. And for everyone else out there, they have a couple mines in Panama that are having some issues with the local government. Let's just say that. And getting clearance and all that. So once that is cleared up, I expect them to bounce back. So the technicals are lining up, and this is, I think, a good buying opportunity. Thanks for the call. Let's talk a little bit about our main focus point today, and that is what rules or lessons can be taken from 2023. We know that stocks and bonds had a pretty good year after a rough 2022. Equities more broadly were up roughly about 25%. The bond market in general, after a big dip through the summer, rallied near the end of the year and ended positive. And a lot of people are going into this year and saying a few things. A lot of analysts are saying a few things. And the first one that people are saying, Luke, is that bonds are back. That you no longer have to worry about inflation, and that you should move away from cash and cash-like instruments like very, very short-term bonds or money market accounts or high-yield savings accounts and extend your duration. Now, that's the one that I would say I wouldn't jump too quickly on that shift. Now, some duration is fine, but you know, a lot of duration I think could burn you once again if inflation does stay relatively sticky. What are your thoughts?
Yeah, I think even if you look at the Fed meetings, the Fed meeting minutes recently, there's a lot of uncertainty. about the effect of the interest rate cuts, about kind of dynamics interest rate hiking path, as well as dynamics more broadly on the global scale. There's a lot of uncertainty in the Middle East. There's a lot of things that can bring about some tension that can crunch supply chains again and reignite inflation. So I think maybe it's a little too early to say what's going to happen with the bond market, and maybe you don't want to jump the gun and push out on that curve too much, because I think the risks are still there that inflation may rear its ugly head again. Do I think that's the base case? Probably not, but there's still a lot of risk out there.
Yeah, a risk of inflation to the upside, in my mind, more than to the downside.
Exactly.
And so while some duration I think is fine, going beyond 3 months that a lot of people are in these short-term T-bills and things like that, I think is good. Maybe going out 3-4 years, that's probably fine through this next kind of down cycle in the economy. But one thing to take from what the Fed has been saying is that their tools, in many instances, in this new world of deglobalization or regionalization of supply chains, et cetera, and heightened geopolitical risk, is that their tools have no impact on that, right? Their tools are very limited, raising interest rates, doing QT, some lending facilities, et cetera, and that's mainly on the demand side. But the supply side is a whole nother ballgame that they really don't have much to do with. And so I wouldn't go so far as to say, oh, yeah, interest rates are coming down. Now you taking a bunch of duration risk again is the right thing to do. I still think you have to limit to that to some degree. Now, the next lesson is cash isn't king. And that's what's my biggest takeaway from last year, is that so many people were huddled into those cash-like instruments because they were getting that 5% once again on their high-yield money market accounts and T-bills, et cetera. And guess what? Equities, almost all parts of the equity markets, did better than T-bills in cash. And so in an inflationary environment, no, cash isn't king, even though it might seem like 5% is a nice juicy yield. Does that make sense?
Yeah, I think that makes sense. I think a lot of people were... I think we have to take a step back and realize probably what this article would have said at the beginning of 2023, which is it's the year of the recession. Equities aren't going to do well. And so with anything, take everything that's being said about projections with a grain of salt. But I think generally speaking, yes, having cash on the sidelines is not going to be a good idea because equities are going to outperform cash.
Yeah, most likely. All right, well, we're heading into our mid-hour break. So we're halfway through the show. That means that time for you to call is now. So we're taking your calls live at 888-99-CHART. Have you been using the Mint app to manage your finances? If so, you are going to be making a change because Mint is shutting down. And the Mint people want you to transfer to their Credit Karma product. But hold on, there is a better alternative, Monarch. That's right. Monarch is the modern way to manage your money. With Monarch, you get clarity, confidence, and peace of mind for your finances. You can track all your account balances, transactions, and investments in one place. And Monarch even has a tool that allows you to easily import your data from Mint. Speaking from personal experience, Monarch's intuitive design, features, collaboration tools, customization, and constant product improvements are far above any other financial budgeting app. And it's ad-free. Monarch eliminates what was previously stressful, confusing, or overly time-consuming. It gives you a comprehensive view of all your accounts, investments, transactions, cash flow, net worth, and more. Plus, create custom budgets, track progress towards your financial goals, and collaborate with your partner. After trying out Monarch for myself, I understand why it's the top-rated personal finance app. And right now, listeners of this show will get an extended 30-day free trial when they go to monarchmoney.com/investtalk. That's monarchmoney.com/investtalk for your extended 30-day free trial. Go to monarchmoney.com/investtalk InvestTalk.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and unbiased guidance. You've come to the right place. InvestTalk, 888-99-CHART.
Hey guys, love the show. This is Corey in North Carolina. I had a question about my IRA. I have a traditional IRA, and I started out with about $2,000 in it. Since been listening to the podcast, and it's grown just based on some penny stocks I've invested in to a little over $12,000 now in just a couple months. I'm 32 years old, and I'm wondering if I should convert it to a Roth IRA just based on paying the taxes up front now, and if I continue to grow it more and more using that Roth advantage of, getting the tax breaks, 59.5 or however old it is you have to be to draw from the IRA. Look forward to hearing the answer, and keep up the good work. Thanks, guys.
Well, congratulations on growing that so robustly, shall we say, over that time period. Hopefully we helped a little bit. Now, doing a Roth conversion when you have low income is typically a good idea. So I'm not sure of your total income and what your tax rate is, but that's all you have to think about. Is that conversion at this tax rate going to be at a rate that is lower than what you expect it to be in the future? So if you are a relatively low earner in a low tax bracket, then this would be a good time to do that conversion. Thanks for the call. Now, Luke, the Fed minutes came out today. It was highly anticipated to get a little more color on what the path of policy will be going forward. And to me, the most interesting takeaway was their discussion of winding down QT, meaning stop shrinking their balance sheet. I don't remember that being something they talked a lot about at the actual meeting. But overall, the market reacted relatively positively, but it didn't really move the markets too much. What was your takeaway?
Yeah, I thought it was interesting that they had a broad discussion on the potential that they were overly restrictive. I think that kind of hints that, although I still don't see them cutting 6 times like some people are saying they will, which just seems absurd to me, short of some sort of systemic shock, that they probably will start to look at cutting sooner rather than later. Does that mean March? I don't know, but it could certainly mean early Q2. That's an interesting point that I think came out of these meeting minutes, and mostly that I think although cuts will happen this year, short of anything else happening that would kind of show that inflation is coming back up, there's still no definite time frame. And so I think overall the market may have jumped the gun a little bit in terms of the drastic fall in yields after the last meeting.
Yeah, I think that's another reason why markets have pulled back the first couple of days of this year. But my biggest takeaway from this is something they did speak a little bit about during the Fed meeting, and that's that they're having a little bit tighter viewpoint of where inflation is, meaning they're not just looking at the 1-year rate, they're looking at the 6-month inflation reading, which is actually below the Fed's 2% target for the first time since June of, and that precipitated them for the first time since June of 2022, saying that they don't see inflation as unacceptably high. And so that was a big shift in their verbiage and their viewpoint. And I actually think this is the best news coming out of the Fed in a long time, that they're not so tied to these year-over-year numbers, because markets and economies, they move pretty fast these days. And a 6-month view of what's happening in the economy is probably better than the 1-year view, especially considering how anomalous the last 3-4 years have been in the economy overall. And they think the overall risk of renewed inflation has diminished, and a few of them saw a different problem really developing, and that's that there is a potential trade-off between their dual inflation mandates, which is controlling inflation and maintaining high rates of employment. So they're basically saying that they're seeing the labor market weaken pretty substantially. And if that does, that could kind of snowball on itself. Now, we'll get some new jobs data on Friday, and that will certainly color how they are thinking about policy going into this next Fed meeting, which comes up at the end of this month, the 30th and the 31st of January. So, like you said, they're not signaling when. They'll certainly continue to be data dependent. But it was most interesting for me anyway that QT looks to be maybe ending at some point this year. And I think it'll be interesting to see which one do they change first. Do you think that they cut rates first, or do they stop QT first? What do you think?
I think it's probably more likely that they start to cut rates first. I think that's probably why the market, although they jumped the gun a little bit, assumed that there would be so many cuts earlier in the year. I think that's probably. I think given that they are too worried about being too restrictive in terms of credit within the system and capital within the system, I think the easiest way they can not be restrictive is to start to cut rates sooner rather than later.
Yeah, I think it's going to actually depend on what problems arise. So if there are more economic problems where when unemployment rates rising, you're having overly weak jobs numbers, I think that would precipitate a rate cut. Now, if you get other problems kind of underlying within the system, for example, if the Treasury market becomes dysfunctional again due to the massive amount of issuance and they're planning with the Treasury not kind of working out as they hope, winding down QT and stopping more treasuries from entering the general market, I think that will be their next step. So it'll be very interesting to see what problems arise, because there's one thing we can guarantee this year. There will be problems. It's just a matter of how large will they be and how well will policymakers deal with them and kind of quell them like they did during the banking crisis in the spring of last year. Now, the more caller questions we fit into the podcast, the better your learning experience will be. So let's play another question from the InvestTalk voice bank at 888-99-CHART.
Hi, Steve and Justin. Longtime listener here from Minnesota. I have a question for you, gentlemen. Been following a stock last year, had a huge run-up. AFRM, I believe, is the ticker symbol, Affirm. Seems like a great business. Still has a long way to run. I believe it follows up with payments and stuff for companies. I notice it's had a pullback here, of course, at the beginning of the year with a lot of people. I don't know if they're doing profit taking or what, but we've had some pullback. And I'm just wondering if this might be a good place to step in and buy some of it, and look forward to hopefully having a run up here in 24. Just wondering what your thoughts are about doing something like this, or what you think about this stock in particular. Thank you very much for your thoughts. Look forward to hearing them on the show. Happy New Year to everyone.
Thank you for the kind words. Happy New Year to you as well. Now, Affirm Holdings, this is your, would you say the leading? I believe it's the buy now, pay later. Is that correct, if I remember correctly?
Yeah, it is buy now, pay later, and I think it is the leader in buy now, pay later.
Mm-hmm. And the caller seemed to think that they had a great business. Would you agree with that?
I think it's an easy business to lend somebody money and hope they pay the interest later. And I think that works really well when times are good, and not at all when times are poor.
And that's my biggest worry here, is the fact that despite unemployment rate being sub 4%, and they being the leader within the space and their growth being good, their free cash flow remains negative. Their return on equity remains deeply negative. Their operating margins remain deeply negative. So to me, this rally is a complete farce. And I actually see this as a pretty good short in my mind. It rallied into resistance here in around $50 per share. And the last day of 2023 and the first 2 days of 2024 have not been kind to it. It's pulled back from about $41 and change. Now we're closing at $43.49 today. So down, nearly 20% in just 2 days or 3 days, excuse me. So I don't know, Luke, would you short it here?
Well, its short interest is 18%, so close to 19%. So maybe if enough people think that this is a good pullback, then they could force a short squeeze. I don't see that happening. I mean, even from a valuation perspective, it's still valued from a price to book ratio basis, more than its a 5-year average. So even if you were considering getting into it now, it's still overvalued, even if you believed that this company was worthwhile, which I certainly don't, because the business model is not one that works for longevity through multiple cycles.
Yeah, and if I were to list all the companies in the market to buy right now, this would probably be in the bottom 10, 15 companies out there. So absolutely not. Do not touch this thing. This thing had its short covering rally, had its counter trend rally in 2023, and it would not shock me if this is one of the worst performers of 2024. Now, we started a new year and a fresh first quarter, and we're seeing new trends emerge. And the big question is, are you ready for this year? Are you prepared? Is your portfolio in line with the current trends? Did you suffer more than the market did over the past couple of days? That could be an indicator that your portfolio is misaligned. So if you want to take advantage of our free portfolio review assessment, then we could potentially get you on the right path to having a great 2024 as opposed to a subpar one. And all you have to do is head over to our website, investtalk.com, click on the portfolio review button on the top right-hand part of the screen, and fill that out, and we will get back to you. We can set up a telephone call or a video conference and get you full reports on what your portfolio currently looks like, how it stands. Is it overweight, large cap versus small cap, or growth versus value? What type of risk are you taking compared to the overall market, et cetera? These are the things that we discuss on these free portfolio reviews. So head over to investtalk.com, and the sooner you do, the sooner we can get your portfolio optimized.
Every investor is working to build a secure financial future.
Calling for your assessment of Blackstone Incorporated.
Everyone's situation is different.
Just wanted to get your opinion on JP Morgan.
And so are their questions.
Get your thoughts on CRM, Salesforce.
Each podcast is unique, and you set the agenda.
I'm wondering if now
24/7, rain or shine, InvestTalk is made better by the power of you. 888-99-CHART.
Hi, Steve and Justin. This is Kevin from La Crescenta, California. I know that you guys don't necessarily follow any particular research or buy any research or make your trades based on any outside research, but I'm wondering if there's any investors, besides Warren Buffett, where you kind of just follow their moves and don't make the trades based on it, but it just kind of piques your interest. If there are any investors you kind of are interested in what they're doing. Just a question I've been wondering. I'll be listening for your answer on the show. Thanks.
Yeah, well, that's a good question. I think that certainly for myself, investors like Warren Buffett, Ben Graham, those guys and what they believe and what they have shown with their performance over time, and how you look at companies and look at markets and decide what things are overvalued, undervalued. Those are kind of, they always say that you stand on the shoulders of giants, and those are certainly some giants that we stand on, or I at least stand on the shoulders of. I would also say that in terms of research, I certainly look at outside research. I'm smart enough to know what I don't know. And so taking in different viewpoints, especially opposing viewpoints, and testing my own hypotheses is an important part of investing to getting to that right answer. What about you, Justin?
Yeah, I mean, modern day great investors, I would say top of my list would probably be Stanley Druckenmiller. He is probably the best track record over history. It's certainly, I certainly look at those purchases that they make. But one thing you learn, even when you study the greats, they all make mistakes, right? They all do things wrong. They all buy companies that can crash and burn. They all buy companies that languish and underperform the market as well. But in aggregate, they tend to do fairly well. And so, when they start a position, for example, I sometimes perk up, I do my own research, and it's never a sole reason to look at a particular name or buy a particular name, but it could be a reason to take a second look and understand why they are buying it. There are other investors like Ray Dalio, for example. He's a great investor, historically. But I don't love his current view of China, for example. And I think he kind of views that as like as a positive trend in geopolitics, and I think that's they're trending negatively. And so I am interested in what he says, but I don't take it for gospel, and I have my own viewpoints. And so you have to do the same, just like you listen to us. Nobody should listen to the show and hear us talk about a name, a caller calls in and we like the name. Nobody should, just based on that, go out and buy that particular stock in their portfolio. That's not how this works. Now, is it, once again, impetus for you to do your own research, understand how that fits in the context of your total portfolio and your risk, and maybe that lines up for you? Sure. But no one factor, whether that's somebody else buying it or some earnings announcement or whatever, is the sole reason you should own something. So we as Luke said, we stand on the shoulders of giants, and there are people we admire from afar and take heed when they maybe buy something or interested in a particular sector, but you always have to do further research. Now, listen to InvestTalk. We have one goal each and every weekday, and that's to help you achieve your own version of financial freedom. I'm Justin Klein with Luke Guerrero, and our work continues after this final break. So get your questions in now at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy and discipline. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Hey, Steve and Justin. First of all, I just want to thank you for the podcast. 2-year listener and try to listen every day. My question for you is about iClean, ICLN. It's a clean energy ETF. You guys are talking a lot about energy. With the recent downturn, I think it might be a good entry point there. Or if there's other ETFs out there, I know you can't say specific ones, but if there's a better one out there, please let me know. I own a little bit in it right now. I'm trying to basically double my position. Thanks for the podcast.
Well, first and foremost, thank you for being a 2-year listener. We really appreciate that. Now, iClean is an iShares ETF that has biofuel companies, ethanol companies, hydroelectric companies, pretty much any companies that are involved within the green revolution here. It's actually split pretty well in terms of size characteristics. It's about 30% large cap, 30% mid cap, 20% small cap. So the problem, I think, and Justin, you'll probably agree with me, and why this fund was down so much over the past year, is going to be around how expensive it is to invest in clean energy.
Mm-hmm.
And
the higher cost of capital.
It's a higher cost of capital. We're still in a world with non-zero interest rates, a world that will persist. They're not going back down to zero. And so for these companies, it's going to be harder and harder to turn a profit because funding those businesses are going to be more expensive. Now, if that's what you're trying to invest in, this fund looks fine to me. Its expense ratio is a little high, but that's probably because it's a more targeted approach. It's going to be more highly concentrated in a couple sectors. It's not just a straight index ETF. It's an active ETF. BlackRock is a great company for managing ETFs. iShares products are fantastic. If you're looking for it, this is probably a good one. But just for me, the theme there is not one that I would be investing in. What about you, Justin?
Yeah, and I think he's confusing when he said, we talk a lot about energy and we like energy. There's a huge difference between traditional energy, talking about oil and gas and coal and uranium, and clean energy. Although you could easily argue nuclear is clean energy. But that's not what this is. This is more, like you said, solar panels, wind farms, etc. And this is in a consistent down trend. And it's in a recent rally. counter trend rally from the lows in late October. But overall, this is in a strong downtrend. You should be selling this, not buying more. And if you want to invest in energy, then you invest in your traditional energy names, right? Oil and gas. And that has a much better value proposition in the current environment where the cost of capital, as Luke said, is no longer zero. And that's one of the big reasons why these companies continue to struggle. So yeah, definitely not adding to it. I'd be selling it and moving on to a traditional energy name. Now, lastly, Luke, let's talk about convertible debt. And convertible debt is going to be, it was a big trend in 2023. Issuance climbed 77% last year to $48 billion. And this is all to avoid higher costs of borrowing. As you said, the cost of capital is no longer zero. And what's interesting about the convertible debt markets typically was for smaller cap names, biotech companies, tech companies, to give investors big upside, right? You're getting some sort of interest rate, usually pretty low, 1-2%, and then you're basically getting call options on the equity in lieu of that extra yield. And so now it's becoming more and more advantageous to avoid those high interest rates up to maybe 8% in the junk bond market and issuing convertible notes. Uber, for example, they issued $1.5 billion in convertible notes in November at a 1% annual rate. And typically convertibles allow companies to drop their interest expense by 2.5% to 3% when they do that. So I think it's going to become more and more of a theme going forward as companies face refinancing of all that debt they piled on in 2020 and 2021 and have to refinance over the next 2-3 years. So something to be look out for. And Luke, isn't that going to be kind of stealth dilution of shareholders when they do that?
In a way, the shares outstanding doesn't really increase until those bonds are converted. So I guess there is a world where the stock price doesn't hit the threshold and nobody would want to convert. But I think the general message here is that in a world where interest rates aren't zero anymore, all companies, not just ones that would face, high interest rates because of credit risk, are going to look to decrease the cost of capital, and in this case, the interest rate required for them to be able to borrow money.
Yeah, and while that could make their balance sheet and cash flow look a bit better, there is something to consider in the fact that there could be share dilution in the future if the price of the stock does go up. All right, that about does it. That completes our second episode of InvestTalk this year. I'm Justin Klein with Luke Guerrero. And we thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights.